The IPO market is hotting up after a period of lull, with 2 IPOs having just concluded with good demand. We have a couple of other companies as well lining up over the course of the next few months. But you know what really keeps or differentiates an IPO is the fact that it does not have much of a financial history. That's especially on public record. So how do you really know whether an IPO is a good one to subscribe to or just stay away from? And how do you peruse through those hundreds of pages of literature that a company releases in its DRHP? We got on board Siddhartha Khemka of Motilal Oswal on how he reads through a DRHP and judges whether an IPO is good to subscribe to or not.
Yeah, it's a very pertinent question, and all the more important because there are IPOs where the RHPs run into hundreds of pages, so 400, 500 pages, and they have got all the details. What we start with is first about the company to understand what the business model is. Then we look at the financial snapshot. Third, we look at the objects of the issue, why the company needs to raise money, whether it is an offer for sale by existing promoters or by some institutional investor or an exit by a PE. That gives some insights as to what the company has done, and say maybe if the company needs the money for a capex, which means that there is a future growth demand driver which the company needs to meet. And finally, and one of the most important part is the risk factors which are listed down at the beginning of the RHP itself, which lists down a lot of factors pertaining to the industry, pertaining to the company, and the promoters and management. So it gives out, as you rightly said at the beginning, that these are the first timers. We have not tracked them, so they were not under the public scrutiny. We don't know a lot or history about these promoters, these management. So the risk factors helps us to understand anything on the history of the company, or they may have done or they may have not done, and things like that.
Okay, all right. I think that'll give a good guide as well for our viewers to start off with if they want to check out the DRHP of the forthcoming IPOs. Siddharth, anything if you could share with us perhaps some examples without of course naming the company, but anything that you would consider, okay, this is a red flag and maybe I should not subscribe to the IPO for now. If you could perhaps share with us with some examples, so that'll be easier for our viewers as well to understand.
Yeah, sure. So if you look at, as I was telling you, the objects of the issue, a lot of times we see that companies that come with an IPO is entirely an offer for sale. And the offer for sale is from the promoters and the valuation is very high. So that to my mind comes as a little bit of red flag to an extent that if a promoter is exiting at a higher valuation, is he not looking at the future growth? Why is he looking at so much of exit? Why is only listing an important factor for him? Compared to that, if you have a PE firm exiting through an OFS, it makes sense because we know that the PE has a definite period of investment. They have to take an exit. They were part of the initial growth story and they now need to exit, and that is where the public investors get into a company, and that leads to an opportunity to enter into the company. Some of the other red flags that can be seen is specifically relating to the financials. If you look at some companies just before the IPO, they show a very good or sharp improvement in the numbers. So suddenly you will see that last 2 quarters, the revenue growth was very high. Margin sees a sharp improvement in the quarterly numbers, and just before the IPO. So that raises some kind of red flag whether the management is inflating the numbers just to attract investors into the IPO. And minded that quarterly numbers are to some extent adjustable, and once we have the final audited annual report, these numbers can get adjusted because some of these are provisional, some of the expenses gets deferred, some of the revenues are pre-booked. So you will see that the working capital cycle becoming stretched, and that is all raises the red flag to my mind.